Hey, I'm Chris with Hard Money Bankers. About 18 years ago, my business partner, Jason, and I started Hard Money Bankers, hardmoneybankers.com. Check us out anytime. We have about $50 million outstanding in the loan portfolio at any given time. So we know a few things about this business and this business model and how great it is. And that's what we're talking about today. First, we're going to compare the private lending model to a few others within the world of real estate investing. We're going to talk about the three main things that you need to be successful in this business. And then we're going to talk about a few of the common mistakes that we see lenders make that can possibly bring them under. Those are the things to avoid. All right, so let's dive in. Talking about business models. Let's talk about wholesaling real estate first. Wholesaling is a common entry into real estate investing because it doesn't require much capital. It requires some other stuff. It requires money for marketing, pretty marketing intensive. People who are doing a lot of volume in wholesaling are doing lots of direct mail, which costs. They're doing lots of online ads, Google ads, Facebook ads, stuff like that. Definitely has a cost. And the people who are doing lower volume, they tend to just know a lot of people in their area, in their city, their neighborhood, and just get deals organically by knowing people. It can be a good model. It's very transactional, meaning you're not owning and managing assets. You're just buying and selling and buying and selling, assigning, acquisition, disposition. It can be a good way to get started, especially if you just have a few one-off deals that don't have a huge amount of marketing costs. I think there's absolutely nothing wrong with getting involved in real estate investing, starting in wholesaling, but a lot of people don't stay there. It's not the best long-term model, and we don't believe it's as good as private lending for sure. That's what we're going to get to here soon. Moving on, flipping. Oftentimes, real estate investors will start wholesaling and then move on to acquire a property, put money into it, and resell it as a profit. That is flipping. Oftentimes, a wholesaler will think, yeah, I could make 20 grand on this wholesale fee in a few weeks, but maybe I'm leaving money on the table. Maybe if I acquire this property, put 60 grand into it and sell it for a good profit in 4 or 5 months, something like that, I could make 75 grand instead of a $20,000 wholesale fee. So it's something to consider for sure. By the way, guys, if at any time during this presentation, you want to schedule a time to talk to our team, just click on the link below, talk to our program director, Dave, and learn about everything going on at the Hard Money Mastermind full of private lenders. So that's flipping. Flipping, pros and cons. You can make some really good money. Our clients are flippers. As a private lender, the majority of our clients are doing rehab deals, and they're great at it. They run crews, they got lots of inventory, they know design, they know their market, and they do really, really well. The tough part about flipping is that there's a lot of skill sets involved. So you're talking about finding the right kind of deals, financing them in the right way, executing on rehab jobs, on construction jobs, sometimes major jobs, and dealing with contractors can be difficult. If you're running your own crews and you have a great team, it can be awesome. It can be an awesome business. You're also talking about design. What are you doing to these properties so that they can sell for top dollar in the area, right? And then in that, you're also talking about a lot of transactional skill sets from the buy side and the sell side. So flipping is just hard. It's not that it's a bad business model. It's just very, very challenging. And sometimes you can it's speculative. You don't know exactly what your bottom line is going to be at the end of this deal. You could put a lot of time and effort and resources into a deal and then clear a small amount of money. And you're like, shoot, I just spent all this time, all these months. So it's speculative. But if you're good at it, it can be very, very good. All right, moving on to rentals. Mind you, in our real estate career, we've done all of these. We've been through all of these, and people watching probably have too. And after doing all of these, we ended up on private lending so much that we even create a community of lenders, and it's our favorite model, easily. That's why we're doing this video here today. All right, so going through rentals. People get attracted to rentals because they're like, okay, I don't have to do constant transactions like in wholesaling or take all this risk and do transactions like in flipping. It's like, okay, I can buy for this much, it's gonna rent out for this, I'm gonna have positive cash flow, this property is gonna appreciate in value over time, and year to year, I'm gonna be taking deductions known as depreciation and lowering your taxable income. That is all true. It's all great, pros and cons, just like any other model. So we've owned a bunch of residential rental properties over the years. We've sold them. We do co-own some commercial real estate, like self-storage, multifamily, office, but we have sold our single-family residential rental properties some years ago. Part of the reason is because they don't make enough money. You have this thing you have to manage, this building, the stuff that comes with it, repairs and everything else. You have tenants moving in, moving out, hopefully not messing the place up, but sometimes they do. You got to manage them. And the cash flow isn't impressive enough. That bottom line on, we can make a few $100 per house per month, maybe more than that, maybe 500 or 1,000 or 1,200, but like, that's not a lot. And compared to how low maintenance lending is and making more than that per transaction, I just don't love that as a business model. So private lending, on the other hand, is the best bang for the buck. Out of all these models, how much work goes into doing one deal? and how much money comes out. That's the equation. That's the whole game right there. In the private lending model, especially when you're using your own money, but it works when you're using investor capital too, is some of the best bang for the buck. You can make private lending, you're talking about easily $10,000 profit if you're using somebody else's money, and double that, $20,000 if you're using your own money, average per deal. And how much time are you putting into each loan in terms of underwriting it, funding it, and then managing it during the term? A few hours, some hours, that's it. Compared to all the work and months and stuff that goes into something like doing a flip or managing, month in, month out your rental properties. It's the best business model. And like I said before, if you want to schedule a time to talk to our team, just click below and schedule it on the calendar. Okay, now we're going to transition and talk about the things that you need to be successful in the business of private lending. And that is deals, capital, and the team to support you. And we're going to go through those. Deals, that means leads for people who potentially want to borrow from you. Real estate investors. We're going to go through a few of the free ways that you can bring in business, because that is the name of the game. It is a numbers game when it comes to leads versus closed deals. And then we're going to talk about a couple of the paid traffic avenues that we use day in and day out. So when we're talking to people in our mastermind group, we like to start with the free stuff. And the free offline stuff usually starts with meetup groups. Meetup.com is a great resource. You can search real estate investing in your area. And depending on where you are, you're going to find a few meetings, maybe even a dozen of them, where you can go and connect with other local real estate investors. And this is a great way to find out what people are up to in their investing career. Are they flipping? Are they acquiring for rental, like the BRRRR method, the buy, rehab, refinance, repeat method? Oftentimes these people need private money to make those acquisitions and to do that rehab. And that's where people like us come in. So going to those local meetup groups can be a really, really good and free way to meet potential clients who are going to borrow from you. I would say the same for auctions. Find out where they're having foreclosure auction sales, because the people who buy at those, it could be at the actual property being foreclosed on. Oftentimes it's at the courthouse steps. And these days there's also some online, which is kind of online auctions have thrown off that auction game a bit, but many of them are still happening offline. And the people who buy there are very legit. They oftentimes have a lot of cash to work with. They use private money when they need to. Sometimes they don't. They just use cash. But that's another good way to get in front of real estate investors in your area that might need to borrow from you. All right, let's talk about some online stuff as well. The first thing you should do, and this is what we teach to other lenders when they come into the mastermind, online, is get together all of the contacts that you've accumulated, whether you've been in real estate or business, lending, banking, whatever your background is, all of your business contacts, hopefully real estate contacts, and put them into a spreadsheet. And that soon is going to go into an email database like MailChimp or one of the other ones, high level. Now, these could be real estate investors. That would be great. Real estate agents are good too. Title companies, mortgage lenders and brokers, appraisers, really anybody that has some kind of access or involvement in the world of real estate, hopefully real estate investing. Put them into your spreadsheet. It's going to go into your database, and you're going to email them once a week. Here's what you're going to email them, because I know everyone stops there and they're like, yeah, but what am I going to email them? I have to come up with something every week. It's easier than you think. So a few things, you can definitely start out your initial weeks just with intro type of content. It can be written or it can be video. And you would jump on a video and say, hey, I'm Chris. We're here in my office in Columbia, Maryland. I'm a private lender on real estate in DC, Maryland, Virginia. Here's the kind of deals we do. Feel free to reach out by email or phone or whatever it might be, a little intro thing. And then you can go through a series of like, let's take a look at this deal. We funded a $250,000 loan. It was $180 towards the purchase price, $70,000 towards the construction. The ARV on this is $425, and just walk through the deal, maybe even do a before and after with pics. Real easy stuff to blast out to your list once a week. And then moving forward, just try to pick out a little win that has happened at your company during the past week. We closed this deal. This one paid off. Again, do some more before and afters. Here's us speaking at a meetup group. Here's our team having lunch. Here's us having coffee with a new client. Stuff like that, right? That you can blast out to your list just to point to little wins that are happening at your company. Between the offline stuff of meeting people in person at meetup groups and staying consistent in terms of marketing to your database of real estate people, you're going to get deals. It's just consistency is key. And that stuff that I mentioned, that I listed there, is all free. Besides the nominal cost of a MailChimp or something like that, as long as your list isn't huge, they're really inexpensive. And some of the paid stuff that we do, Google ads, we've been running Google ads since we started in this business 18 years ago. They were good then. They were way cheaper. Don't get me wrong. They were way cheaper back then. But the lead flow was good then. It was quality then. It's quality now. Only difference is it costs more. It doesn't have to be Google. It can be Meta ads, any other place where you can find some paid traffic. LinkedIn's another one, and they cost, right? Like you're going to be paying $100, maybe $200 per lead. But remember what I was talking about with the minimum profit on one of these deals being $10,000. So if you're paying $100 per loan application, you got some money to spend. You can spend 100 of those, get 100 loan applications for $100 equals $10,000 and still break even. And chances are, if you get 100 loan applications, you're going to close way more than one. So that's why this high ticket item, a private loan is a high ticket item just based on how much profit comes in per transaction. It's pretty easy to run paid traffic for. Like compare that to, say you're selling an article of clothing for $100. How much can you spend to make a $100 sale? That's pretty tough in terms of cost per click and how many people are going to come. Like that's a tough game for paid traffic. But if you're making $10,000 per sale, all of a sudden this gets way, way easier, right? So that's how you can, after you do the free stuff and after you have some repeat customers in your area that you've met offline, I think it makes sense to start moving towards paid. Once you have revenue coming in, you have an outstanding portfolio, maybe you have 5 million, maybe you have 10 million outstanding, adding in some paid traffic can really, really boost that, because the reality is this is a numbers game. You get a lot of leads, a lot of them don't work, some of them do work, and you put out loan terms, but they're not accepted by the potential borrower. So it's a numbers game. That's what this business is, right? Let's move on and talk about capital. So we are firm believers that this business is best run with private capital from high net worth individuals, not institutions, not Wall Street, not banks, not any of that stuff that we'll get to some of the pitfalls here in a bit. High net worth individuals. Now, a lot of people get into this business because they've accumulated some of their own money and they want to lend it out, and they want to do it for a good rate of return, and they want to do it safely. If that's you, definitely click below and schedule a time to talk to our team. We'd be happy to work with you. You're in a great spot if you're just looking to lend your own money, but it doesn't have to be that. It can be a mix of your own money. It can be none of your own money. It can be all investor capital. In our system, it's always been focused on that. It can be organized into what we call direct placement or co-lending, as long as you have the right legal documents in place. Of course, I'm not a lawyer. I'm a private real estate lender, so consult a securities attorney on anything related to capital. Co-lending is a common structure, and then also a debt fund, a Reg D debt fund that a securities attorney can explain to you is another common way within our mastermind group that lenders are organizing their capital, right? But in either situation, you're talking about high net worth, usually accredited investors, not the other stuff that we were talking about related to banks and credit lines and Wall Street and everything else. We'll get to that in a second. Okay, let's break down. You're probably thinking like, oh, where do I find high net worth individuals? So when we started, there's no one in our first degree network. So those are the people that I know directly, that Jason knows directly. And this is back, when we started 18 years ago, that we could pick up the phone and call and say, hey, I need a few $100,000. I need $1 million or something like that for this real estate deal we're lending now. There is nobody in our first degree network that we could pick up and call just like that. But we found out through a good amount of work that in our second degree network, so the people we know, everyone they know, was all the money that we would ever need for this business to this day. And it took some work to figure out who the best candidates are. So I'm not going to dive too much into the DISC personality profile, but I did want to mention it because that's one of the pillars of our capital raising system, is that DISC. Check it out when you get a second. We've always focused on the D, the dominant personality type, and the S, the steadiness personality type, as the most common personality types that work well with us and with our business and this type of investment. Now, some common professions for the D personality type. You're talking about a lot of business owners, finance people, real estate people, maybe attorneys, some accountants in there too. We have a few accountants who invest with us. And then on the S personality type, this is more of a passive type of investor. Maybe they are a self-directed IRA investor. They could have held during their career, they may or may not be retired at this point, more of a support kind of role, executive assistants, kind of hold down the fort. Like S's are super important. They're the glue that keeps everything together. S personality types are awesome. As an investor, they tend to be a little more passive. They don't need to underwrite too much. It's more of a trust relationship. Like they trust that you are good at what you do and are going to take good care of their money, and they're not going to bother you with details and questions and what's going on here. Like they're just more passive. That's their personality style. It's also their investing style. Those are the two that we focus on, and some of the common professions. In terms of investable capital, when we first started in this business, I thought that we needed whales. I thought that we needed 8-figure net worth ready to throw into like 10 million and up, ready to throw into private lending. It turns out that wasn't the case at all. I think people with that kind of net worth, they have access to a lot of stuff: deal flow, potential investments, business partners. And as you go down in net worth, I think that a lot of people in that like 100K to 500K, maybe 750 liquid that they can put into this kind of investment, people in that range might not have the same kind of access. So when you put an opportunity for them to earn a double-digit rate of return, which this is, we're typically lending at 12.99%, paying our capital investors 10. It's really solid. There aren't that many places where you can get a consistent 10% return. So when you have that kind of opportunity that you can give to people that are in that kind of investable capital range, again, like 100K to 500K, maybe 750, we found that to be a pretty good sweet spot. And then of course, whales come in over time. Like after you're doing this for a while and people hear about it, there's people with higher net worths that will gravitate towards you. And it's really about the deals. Like if your deals are so good that they take a look at it and they're like, this is a home run deal. Why are they paying 12.99%? Why wouldn't they just go to a bank? Usually the answer is because of time, but that's a great question to get from a capital investor. If somebody's asking you that, why are they borrowing from us at 12.99 and not just going to a bank for cheaper money? That's a great question to get. That's them confirming that your deal is awesome and this borrower looks really qualified. And they are. It takes a lot of marketing and a lot of work to make these relationships with real estate investors, but they are very qualified and they do perform very well. And that's the kind of stuff that you want to put in front of potential capital investors, deals that they can't say no to. So just to recap on that, even if you don't know anybody in your first degree network that you can just pick up and call and they'll give you $1 million, I would look in that second degree. Do the hard work to get introductions from the people you know, because the people they know will give you access to all the capital that you ever need. Learn the DISC personality profile because the D and the S are very helpful. Common professions like I named before. On the D side, business owners, real estate, finance, attorneys, and then more support roles when you're talking about the S personality type. So the third thing that you need to be successful in this business is a team. Who's on your team to start? When Jason and I started, we were the only ones here and we had to figure out who else was needed in this operation to make it work. So one, even before you hire your own staff, we're talking about the outsource kind of team, and then we'll grow into the in-house team as well. You're going to need an attorney day one to do loan documents, to do title review. This is super important. A lot of people think that they can just be like, oh, I'll just find a real estate attorney or maybe a title attorney who's doing the closing to do a note and a mortgage for me. It's really more than that. To do loans, you need more than that. It starts with title review and negotiation. So the attorney that does loan documents, and this is a very specialized practice. Like this is not a regular real estate attorney. It's not a title attorney. It's somebody who specializes in doing commercial loan documents for investment real estate deals. Very niche, but they're out there. We could probably refer you to someone based on where you are. When you click below, schedule a time to talk to our team. If you need an attorney, ask Dave, our program director, will point you in the right direction because they're going to negotiate the title policy for you. When you first get a title policy from a title company, they're going to take every exception that they can to minimize the coverage they might potentially have to pay out in the future, right? They're an insurance company. That's what they do. And our attorney's job, first of all, is to negotiate that policy. Remove this, remove that, to give us more coverage. That's the first part of the job. The second part of the job is doing the actual loan document. Your guarantee, your commercial affidavit, mortgage, or deed of trust, depending on what state you're in, and the other documents that go into a loan package, which ends up being about 80 or 100 pages long, depending on the state. It's important stuff, and that's going to protect your interests in the future. And having a solid attorney is also key to raising capital because a savvy investor, they're going to ask you about what you have going on legally. So that's a very, very important person to have on the team day one. Also, accountant. Let's figure out how you're going to be managing this portfolio. Now, there's some great software out there. You may or may not want to use it day one because there's a cost to it. A lot of people, including us, do start using QuickBooks and spreadsheets to track what they have going on. It's manual, it's slow, it's not great, but it's very inexpensive. So I understand why people start with that. And then they move to one of the industry software like Lender, the Mortgage Office, Mortgage Automator are the big three. I think there's some other ones as well, but those software will do fantastic things for your operation, and they're built exactly for this business. It already comes out of the box doing the vast majority of what you need. Accountant to work on how the money's going to flow, all of the structure of are you an LLC? Are you an S Corp? How that's going to work. You need all that stuff day one. I would also say inspector, but I'm going to put a little caveat with the inspector thing. It makes sense to start out doing a lot of your on-property inspection stuff yourself at first. You can't do it forever. We didn't do it forever. But when we're out there doing an upfront valuation, now we're getting a lot of this information on MLS. That's another key to this business, is being able to underwrite residential real estate on MLS. But being on the property is important too, to get used to what these deals look like, what these construction jobs look like, to be face-to-face with your borrower. It's huge. And then also when you're doing construction draws, when you go out to the property, you see, okay, this $20,000 worth of work has been done, reimbursed. Back in the day, I used to drive around handing out checks. Now we send wires, of course. But being on the scene as your own inspector is important. But then you're going to get too busy and you're going to have multiple draws this week going out, and you can't be everywhere at once. Not to mention you want to be in your office or in your home office working on new deals. So then you're going to get an outsourced inspector. That's one of the first hires for sure. And it doesn't have to be somebody who's W-2 on salary on staff. You can just pay them per inspection, which the borrower is paying for anyway. So depending on where you're located, how big the geographic area is, you might need a couple different people, and that's cool. That's totally normal and an expected part of the business early on. Now, I don't want to go too much into growing the in-house staff because that does come with time. Like you can do this 0 to 10 million in a portfolio with you, maybe one other. And so oftentimes there are two positions that could either be two people or one people. And it also depends on if you're a solo operator or if you have a business partner. Having a business partner gives you more manpower, of course. But first things first, lenders want to delegate the accounting, the loan servicing software, all the keystrokes that go into it. There's a lot of movement with a loan portfolio, and most entrepreneurs want to pass on the accounting bookkeeping as soon as they can. And then the second one is a processor or portfolio manager, as we call it in our company. A lot of this job is getting files ready for closing, getting all the borrower documents in, getting your third-party inspections in, insurance, title work, all that stuff, coordinating with the attorney who's doing the loan documents. That processing job is another one that lenders want to pass off. They want to delegate as soon as they can because there's a lot that goes into it, a lot of communication, a lot of back and forth, a lot of keystrokes. Sometimes you can combine those two into one, your loan servicing accountant and the person that is preparing and processing loans. It really depends on their background, their skill set, and their personality type. Because oftentimes the person who is doing the keystrokes as an accountant doesn't really want to be client facing. They don't want to be communicating with clients and third parties all the time. It's oftentimes a different personality type, but sometimes you can combine those two into one. It's just something I would be aware of in terms of personality types and how people are going to fit into your operation and be happy doing it, right? So those are three things that you need to be successful in this business. You need the deals, you need the capital, and you need the right team in place. Now we're going to go into a few things that are pitfalls that we see happen. The major things that bring lenders down for you to avoid. One last time, if you haven't done so already, click below to schedule a time to talk to our team, to get on the calendar, talk to Dave Bauer, our program director, learn everything about the mastermind and the meetings that we have coming up. All right, leverage. In the lending business, leverage will kill you. Too high loan amounts, too high LTVs can lead to losses. And this is something that it's tough in the lending industry. Oftentimes, lending companies are competing on the very thing that gives them risk, that creates potential losses that could almost bring their company down. And that's leverage, that's loan to value. So being a disciplined lender in terms of how much loan you'll give to this person on this property is the name of the game. The problem is your competitors, they want to go, oh, I'll give them a higher loan amount. Oh, I'll give them a higher loan amount. And at some point in time, these people are going to take losses and be out of the game. But until then, they're going to be putting out crazy loan quotes. Again, this is why we need lots of deals. This is why we need lots of leads so that we can quote lots of deals, terms, and get the ones that are good. We don't have to stretch ourselves out in terms of risk and potential losses in order to get deals. We'll just be better marketers and get more leads. Got it? Okay, leverage will kill you. Geographic area. This is another common mistake. People think that in our area, we're in DC metro area, we're in Maryland. Just because we know this market and know how to lend here does not mean that we're going to know New York or LA. We're not there. The laws are different. Everything works different. In the US, stuff changes around based on where you are so much. Foreclosure laws, licensing, all kinds of stuff is different. This is another super common mistake. Just because you know how to do a loan in your hometown does not mean you know how to do a loan in Chicago. Keep that in mind. It's another common pitfall. Deal type. Here's another one. You might be comfortable doing rehab loans or fix and flip, as they're called. Very common type of lending in this business. That doesn't mean necessarily that you know how to do ground up construction. It doesn't mean necessarily that you know how to do commercial, like office or retail. You can learn it. You can get into it. You can be careful, learn everything you can, but you're not going to know right out of the gate how to do every deal type. Another super common mistake. Another very common mistake, and that's very, very prevalent in the industry these days, is getting into bed with smart money. Because of course your high net worth investors, they're smart. That's not what I'm talking about. I'm talking about institutional. I'm talking about Wall Street, banks, people who set the rules of the game and almost lure lending companies in to use their capital, signing their agreements where if something goes wrong, you got to buy back a loan. It's kind of a sketchy game because they give you the underwriting guidelines. They're like, okay, here's the credit score you need. Here is the loan to value you can do. Here's how much construction versus purchase. All the underwriting guidelines they give to you and the pricing, here's what it's going to cost. And then they fund it or they buy it from you after you fund it. And then if something goes wrong, they might make you buy it back, even though it was their underwriting guidelines that you underwrote to in the first place. So getting into bed with smart money a lot of lenders, they get tempted by it. See, back in the day, this wasn't around. We only had the option of high net worth individuals. But then, 7 or 8 years ago, this institutional money comes out and they start offering cheaper terms, more liquidity. Like maybe you didn't have access to $50 million to do deals this year. You get access to 5 or 10, but maybe not 50. And here comes Wall Street. They're going to give it to you and it's going to cost a little less. Only problem is you're signing on the dotted line after may or may not reading all the fine print that goes into a mortgage loan purchase agreement. And there's all kinds of stuff that can go wrong there. And that can bring down a lending company. I would say, like we have, maintain the discipline to stay with your high net worth individuals, capital that you control, your own money, people that you know personally, and not institutional money that could pull the rug out from under you at any time. So to recap, everybody, this is without a doubt our favorite business model in real estate. We went through the things that you need to be successful at it, and we went through the things that you need to stay away from to make sure they don't bring you and your lending company down. And if you can execute on all that, this is a fantastic business. We've been doing it for almost 20 years now, and we're hoping to go for another 20. If you're interested in getting involved with our community, please click below, speak to our team, and we hope to work with you soon. Thanks.